And you know that sound. That means that we are live here on our halftime report, 12/19/2018. We've got Coach Matt, myself, producer Cody, and Coach Mark is here. I don't know if he's from the bunker, Matt. You're from the bunker. We're all from the bunker today, but it's definitely Fed Day. It's one of those type of days where you're going to sit and look at the big picture and debate it and discuss it, and we are going to deep dive into that. Matt, how you doing first off?
Tim, doing really, really well. Excited to be here with the halftime crew on a very important day for the market. Obviously, a day that everybody's kind of been waiting for the last 2-3 weeks, and it's Fed Day. So, yep, Fed Day means I'm coming from the bunker.
Which means that you're hiding in your basement from your wife and kids. Is that right? While they're doing.
That's actually the definition of being in the bunker. Yes.
Well, Matt, you and I, our kids are in the same school, and they are already off for Christmas break, and so they're home. I definitely have to close the door to my office all day because there's a lot more noise in the house during the day, which is great. It's great.
What is this nonsense? 2.5 weeks off of school for Christmas. Come on.
Well, you send your kids to private school. That's what happens, I guess.
Well, no, it's fun to have them here. It's just really, really loud.
Is this what you guys do? Do you grab ass about kids on this show every day?
We grab ass about random things every single day.
Mark, we always have a little segment where we do a little something fun. We like to try to keep it light, which is where you just brought in the comic relief. I like that.
Yeah.
By the way, 19 years ago today, Cody brought this up in the prep. President Clinton was impeached. No, it was 1999. I looked up the date. I've got it on Google.
Okay. So 19 years. Okay.
Although, did you see the Alex Jones video the other day?
No, but can you give me?
Google is the enemy. Google's the enemy. They are spreading lies about me and my family.
Yeah. Google's the enemy, but and we may be going through another impeachment on the 20-year anniversary. So it's going to be a fascinating time politically, but that's down the road. We obviously have an important discussion today on the central bank and what they're going to do, and how the market's going to respond to it. Obviously, we're going to read it with our eyes and read and react, and the tackle traders will always, in these volatile and uncertain conditions, will approach everything with caution. And not be prone to just go be aggressive on an initial reaction to the market, because I'm not sure the initial reaction to the market today and honestly coming throughout the rest of this week is going to be an indicator where the market's going to be going in the longer term.
No, I don't think it necessarily affects the fundamentals either, but it is an important day. Mark, when you and Matt and I, when we started trading, Fed days were huge. I mean, whenever the Fed had an interest rate policy decision, you would get extreme volatility. For the better part of 7, 8, 9 years, though, since we've gone through QE and the new bull market, the Fed meeting became kind of a boring event. In fact, traders, it was almost an afterthought. You wouldn't get the big 2-3% day. You wouldn't get the big rally or sell-off or reaction to it. But you were saying something with Matt when I popped into Zoom and kind of joined the conversation that I thought was really dead on, and I want you to kind of go with this. This one feels like it could. Now, it doesn't mean it will, but it does feel like it has more built into the anticipation here. Why do you feel that way?
Actually, I want to hear you do more Alex Jones impersonations.
I got a million of them.
He's got a few.
I was actually pretty impressed. I was like, that's not a bad Alex Jones impersonation.
I do a pretty good Alex Jones.
I liked it a lot, actually.
No,
I mean, Matt and I and Tim were chatting for the last hour or so. And, I mean, one of the things about the Fed, for the longest time now, years and years and years now, is the Fed meetings have been actually fairly anticlimactic. The Fed has done a wonderful job of being transparent in its policy decisions, of providing really transparent thought about where it's going, what it's thinking, what it's doing. Yes, there isn't 100% unison. Sometimes you'll have one of the Fed members give a speech that gives some contrarian views to the mainstream, but it's been a pretty transparent body, which for markets generally, I mean, we like transparency. It allows us to make the most accurate decisions possible with the information that we have. Now, this is, from a theatrical standpoint, perhaps the most interesting Fed meeting and period of the time period for the Fed that I've seen in the last decade, because you have this political theater going on Twitter from the White House, essentially battling the Fed in a public forum, trying to sway its policy and how the Fed might react to that, coupled with market conditions that are near support, that has had one of the worst Decembers. The financial media the last few days has loved to point out how December is the worst December for the market since the Great Depression in the 1930s. I saw a stat the other day, since 1931, before today's little mini rally off of support, has been the worst December since 1931 for the market. So here you have this political backdrop of a White House concerned with its own re-election ability in 2020, needs a healthy economy, needs a healthy market. At least that's what their belief system is. With market conditions that are the worst conditions in forever, with a Fed that many expect to raise interest rates today. It's great theater for those individuals who like this, and it has a lot of practical implications to short-term direction in the coming days on what the Fed decides today. So it's really, really interesting for any student of markets and politics. I mean, it's a really interesting Fed meeting for the first time maybe in a decade.
I agree. There's high anticipation here, Matt. They're all 11 sectors are in the green here today. The market is putting what they call a risk-on sentiment in front of this meeting. I don't know if that's wise or not, but you are getting a rally out of the market in anticipation. In fact, we started breaking down on the S&P at 2,600 on Monday. We're 22 points away from that. React to what Mark's talking about here as well. Do you have the same anticipation for this meeting he does?
Are you kidding me? I got the popcorn. I'm gonna be live tweeting Jerome Powell and all that jazz. I'm ready and fired up for this. I certainly agree with Mark, though, in the sense that the Fed from really 2011 on was pretty straightforward, transparent. Even if you disagreed with their quantitative easing and their zero interest rate policies, they were very, very accommodating for years and years and years and years, and were very open about being accommodating. And it wasn't until recently, really kind of in 2015 with Janet Yellen, where Janet Yellen really kind of lost the rudder in steering this ship, to be perfectly honest with you. And she started, not being as transparent with us, and the market didn't really respond in 2015, didn't really respond in 2016. Obviously, 2016, you had the election as well. But, Jerome Powell has been very, very consistent with his interest rate discussion over the last year. The Fed is supposed to be a non-political, non-partisan body so that they can, make decisions over monetary policy without political influence. And for the first time, and I'm certain this happens behind closed doors all the time with presidents. I'm sure it happened with, President Obama, and I'm sure it happened with President Bush and President Clinton. In any rising interest rate environment, I'm sure the president tries to put a little political pressure on the independence of the Fed and not raising interest rates. But to happen every single day on Twitter, the do what's right campaign, right, on Twitter, do what's right. The market can't take it. The economy. I just love this narrative. Do what's right, right? The economy is doing better than ever. Do what's right. Lower interest rates. And it just makes zero economic or fundamental sense. But that's the narrative that is being pushed out there. And I agree that even in the last few years with the transparent Fed, there has been a few situations, most notably William Dudley or Bullard, who will come out there and say, no, let's keep low interest rates. But, it's going to be interesting because this is the first meeting in a while where there was some degree of, oh, my God, what are they going to do? It's for the longest time, everybody was expecting a rate hike in December, and there's still a projection around 70 to 72% that we're going to get that projection in today with an interest rate hike. But the uncertainty really isn't in the interest rate for me. The uncertainty for me is in what they say for 2019. What does the dot plan say for 2019? The market right now does not expect interest rate hikes in 2019, guys. Even with the 12% drop from the peak to the bottom here, the market does not expect interest rate hikes. But the Fed has indicated that they're still going to hike 3 different times in 2019. So my expectation is this. The Fed, and I want to talk to you guys about how the market will respond in this situation. I expect the Fed to raise a quarter of a basis point today. Okay, that's number one. Number two, I also expect the Fed to lower their projections of interest rate hikes in 2019 from the current 3 to maybe 1 at the max, maybe 2. And if that is what we see today, both in the announcement and in the conversation that Jerome Powell has in his interview process, his Q&A process after the announcement, if that is what happens, how does the market respond to that?
Well, obviously, we're going to have to wait and see. My initial reaction would be upward, maybe in the short term 1 day, but then I think the bears aren't going to let that stand necessarily. Now, it doesn't mean they will fight today. You remember when Jerome Powell was on Wall Street giving testimony at the Economic Club of whatever? I can't.
Yeah, it was last week.
Yeah. And the market rallied, on his testimony. But then it immediately sold off like almost right after that, So there's not a lot of fall. Even back in August, Matt, we talked about this when he was at Jackson Hole. Yeah.
That's right here. That's the New York speech. Rallied into resistance, and it's down 5% since then.
So over a day-by-day basis, who the heck knows? I love what Slavic said. I'm going to wake up tomorrow and make money in the market, right?
I agree with that, Slavic. That's why I love Slavic.
There's a lot of reasons I do, but yeah, I agree with that sentiment. Who cares where it goes? But I don't think it's a good sign for the market if the Fed is softening their stance on interest rates. The Fed raising interest rates is a sign that they think the economy is healthy and normalizing rates. Okay. Remember, the stock market is not the economy. They should want rates to go up and allow banks to kind of make some more money in the debt market, change that relationship of it. I don't think it's great, Matt, for the market if they are saying, okay, listen, we're cowering to Trump. I know they're not going to say that in the official Fed policy statement. That would be a shock.
If they don't raise rates and lower economic rate hikes for projections in 2019, yes, they're bending the knee to Trump.
Yeah.
You can call it whatever you want, but they're bending the knee to Trump. It's political pressure.
Interesting. On the S&P here, you have one green candle after 4 red, Matt. You're in a continuation downtrend, just pure technicals, aside from any of it. Even if it does rally, it's rallying into resistance, right? I mean, there's not really a scenario. What are we thinking here? Even a 2% rally puts you up another 50 points on the S&P. You're right at that old support new resistance zone, so you're
for this to get bullish, Tim. It's not happening in the next week. I can tell you that there's just too much resistance above that. Regardless of what the only scenario I could see possible where I would be like buy is if the Fed doesn't lower rates and the Fed indicates that they're not lowering rates. That they don't increase the rate today and indicate that they're not going to raise anything next year. Yeah. And at that point, you should see a fairly strong rally if that's the case. Because that would be an indicator that they might start slashing rates coming into 2019. And if that happens, there is a 0 interest rate projection in that environment. So my whole take, and maybe I'm wrong on this, but this is my take. At some point, some generation has to step up and say the craziness of the financial world and the debt and the inflation, it's got to stop. The free money's got to stop. We can't move on into an environment in the next 10 years after historically low interest rate policies where we had 0 interest rate. We had $4.5 trillion in new money coming in through quantitative easing. We increased the money supply by about $10 trillion. Equity valuations in the last 10 years are up about $14 trillion, and that does not include real estate. So you can't, in that economic environment, the biggest fear I have is making this low interest rate environment the new normalcy. Okay, moving forward into the future generations. And I'm really fearful that we're going to make that misstep. I see so much out there right now in the news on Twitter. Oh, don't raise. Save the stock market, save the stock market, save the stock market. I'm like, it's bigger than that. It's more important than that. And last I checked, saving the stock market wasn't a mandate at the Fed. So I don't know. My hope is that the Fed will do what's right and bring this interest rate into a normal interest rate environment. And even if the market does tank, like I said last week and the week before, we'll short the market as it goes down and we'll buy the dip when it hits the bottom.
Matt, I know that you're a student of economics and economic history, and I will tell you this, and you already know this, that you absolutely may be wrong about that. Because it started with Keynes in the 1920s and 1930s about this whole free money thing. We now have a movement towards universal basic income and low interest rates. And Ben Bernanke issued this new rhetoric, new way of thinking that we could do QE forever. There are economists that think we might just be able to keep free money forever and the economy can stay strong. I know, I agree. But there is an entire, field of respected economic thought that does disagree.
Yes.
And maybe Jerome Powell bows to
I
that.
am an old school capitalist, Adam Smith capitalist. I believe in bottom up economics and small business creation. I do not believe we should gift money to Wall Street and the top of the market in every single capacity, because we've seen the evidence that does not trickle down. So could this old school Adam Smith capitalist be wrong in a free market and free money market environment that the Keynesian economists have brought forth over the last 92 years? Yes, I could be wrong.
Maybe like that old movie, Miracle on 34th Street, this Fed meeting will be like a miracle on Wall Street. We'll have Santa Claus bring him a gift and it will rally. We'll see. I got a lot of charts I want to get to. Let's break them down. Mark, I want you in on this. So we're going to analyze these as we go. Top gainer on the S&P today. Got to give credit where credit is due. General Electric up about 6.5%. No news of note coming off the bottom. Ugly chart. You buying that breakout right there at 8?
No, I'm not. I'm not buying the breakout of 8, but I will tell you the breakout of 8 could be legit.
It is tradable for somebody very aggressively counter trend trading. For me to go long GE, it would take it would be more than what the Fed has to fight. I can tell you that. There's not a chance in the world I'm going long GE. That company is a trash company, in my opinion. General Mills, AIG, new field exploration. AIG, Matt, up 6%. Here's a company. We're talking about Fed quantitative easing, all these bailouts from 2009 that now has produced this 9-year run. AIG was one of the beneficiaries of that. Here's an example. Maybe we should have let them fail back in 2000.
Yeah, this is what happens when you bail out a bad company.
Yeah, it still is rallying off the bottom. Ugly chart, ugly trend, but a nice 6% day. And this is the concern, by the way, and we do this every day for a reason. I always look at a lot of the different charts and break down the individual components. When the market's up 1.5%, the headline for Halftime Crew and out there, we see that and we're like, okay, the market must be strong. You go in and look at the top gainers. It's all these trash companies coming off of bearish retracements.
It's bottom picking.
Yeah, it sure is. And short covering and some other different elements. FedEx down 9% on earnings. Now, here's an example of that old edict that the market is not reverse thinking, it's forward thinking. Mark, they came out, they missed earnings, down 9% here. When a company like FedEx at Christmas time that should be getting a lot of profits from shipping has a bad earnings report and warns about 2019 and their revenue projection, you see a gap down here. Mark, let's get your read on this one. Marky likes to stay on mute and stare at me. I like it.
No, I'm just looking at the weekly chart. I mean, you broke the 200 weekly last week on FedEx.
Mm-hmm.
I mean, the 200 weekly is a, huge, mega long-term trend average. The thing about all of these charts, you looked at GE, you looked at AIG, they're rallying into trend resistance coming down. It's like there's no technical signals on those two bullish charts. I mean, on those two charts, GE and IAG, they're rallying. No matter how bad a market is, it doesn't go down every day.
Mm-hmm.
You have short covering. You have, when momentum starts, people take their profits that were bearish.
Mm-hmm.
That doesn't mean there's any switch from a technical standpoint. Both AIG and GE, both are below weekly short-term moving averages, pushing down. And then you have charts like FedEx that just free fall. They break through that short-term support. You look at FedEx there, broke through that short-term support at the start of the month. And those individuals that listened to technical analysis over the last few months of this volatility have killed it. They make money, consistent money, time and time and time again, because these signals have been strong and they've been producing money. Like, it's so easy on any given day when the market's rallying to be like, oh, what does that mean? What are your signals that a stock or the market is actually reversing? An up day doesn't mean anything.
No, it doesn't. One up day does not mean anything. We're still in a downtrend, and I think it's a very important point on the big picture, Matt.
What you and Mark were talking about just barely is very important when we talk about the overall health of the overall marketplace. When you're looking at the S&P 500 here, Tim, if you get any positive days coming out of here, what's it led by? It's led by hitting into staunch levels of resistance and further downward movement in pressure because support levels are weakened. So it's what we're seeing across the board. It's what we've been talking about for 3-4 straight weeks now. anytime you see any strength coming into resistance, resistance has held and pushed the market back down and back down further. So until that pattern stops, I'm going to keep on doing it. I'm going to keep on shorting the market when it hits resistance. At some point, it will fail. Maybe it fails this time. Maybe it fails in 2 weeks from now. Maybe it fails 6 months from now. We don't know when that situation will change. So until that changes, I'm going to be a buyer off of support in the very, very, very short term. And when I mean short term, I mean day trading type short term. And I'm going to be a swing trading seller at resistance points.
Mm-hmm. Yeah, I agree with all those things.
Anybody that had been if anyone over the last few months had done what Matt said, short term, if you're doing day trading or 1 or 2 day trading, kind of quasi day trading, whatever the market's doing, go with the flow. Then during these rallies, you'll catch them.
It's true.
But if you sell at what Matt said, at resistance points from a technical standpoint, had you been a seller at resistance points, you had some huge monster wins. Don't try to be the smartest guy in the room. What's the chart?
The market. Don't try to beat the market. My mentor once told me this. If the market's dancing the tango, you can't dance something else. Right? You can't go do the 2-step. You got to dance what the market's dancing with. And that's just another creative way of saying the overall trend is your friend. Trade with the trend and don't try to outthink this.
I think that your mentor was Al Pacino then, because that's exactly what he said in Scent of a Woman. I'm not saying your mentor did not say that, but Al Pacino also said that in Scent of a Woman. That's right.
Usually great one-liners come from great movies.
That's right. Yeah. It's a great scene. He's dancing with a girl in a ballroom. He's like, hey, when you get all tangled up, tango on. If we're
I don't think my mentor said it like that, but
no.
But I digress. You got to go with the market flow. Right.
Give me AGN if you would, Matt. One of the other top losers on the market today. Maybe the headline of the day for me, grabbed my eye. There's no doubt about it. Allergan stock falls towards 5-year low after suspending sales of textured breast implants in Europe.
Holy cow. Point out look at that support level. Look at that support level. This is what we're talking about from a technical standpoint. Let's say you ignore all the news. I like to live more and more in a bubble where I don't listen to anything that's going on.
I can attest to this. He doesn't listen to anything that goes on.
I know, because everyone's an idiot. I'm an idiot too, because if I listen to stuff, I can get influenced. So let's forget why it broke support.
Mm-hmm.
If I'm looking at a chart.
So you don't care about the breast implant story? Is that what you're saying?
It doesn't matter. I don't care if it was that or if the CEO got caught with dead children in his trunk, her trunk.
I got to tell you right now, Tim. I know our brother very well, and I knew this was either going to be. He was either going to say something about dead children or dead hookers. I didn't know.
Well, I was debating. I
didn't know which
one. But it doesn't matter why it broke support. That is a clear downtrend, a short-term to intermediate support level that got set up, and you have a clear break of it. So I don't care why. I don't care about the news. From a technical analysis standpoint, if you can be objective and have a trading plan on how you take advantage of these type of setups, whether it's FedEx or GE or AIG, go pull up AIG, Tim, because we're looking at day one of Allergan. Look at that support level from earlier this year on AIG. Look at that huge support level that was formed. Mm-hmm. So when it broke that support level, I'm sure there was a headline or a reason or something that served as its catalyst. Breaking that support level, had you just said, all right, I'm going to make money on the break of that support level on AIG. I mean, go look at AIG. What did it go from 52 down to 36?
Mm-hmm.
I mean, that's a lot of money you can make, whether you're an option trader, shorting this.
It doesn't matter, but you take AGN, Mark, and one of the things I want to talk about in this, because this is a stock that in the last 2 years, it went from 317 all the way down to 135. I mean, it's down 60%.
So here's something I've heard over the years, Matt. Doesn't it have to go back up?
Don't bottom pick. No,
it's got to go back up. It's a good company, right? They got good product.
Yeah, maybe hypothetically, but we don't know that.
Well, but my grandma,
AIG a year from now, 2 years from now, might be back up at 52. Does that mean you didn't make a ton of money on its way down? Like whatever it does long term, as traders, if you make money on a breakdown in a 5, 6, 7 week period, it doesn't matter what it does in the future.
Yeah.
These support level, like incorporating support and the break of support or the break of resistance can make you a lot of money. You're going to trade for decades. Every individual out there in 2019, 2020, 2030, you're going to be trading. If you identify these really significant breaks of support and resistance, find a way, a strategy that tells you when to get in, how you'll manage the trade, and when to get out. And that's what we do at Tackle Trading every day, helping people formulate those plans. You're going to make a lot of money on AIG, on FedEx, on GE. GE's had many breaks. And today on Allergen.
Mm-hmm. Here's my take on it. I don't trust any breakout right now of resistance, because usually that is met by multiple layers of resistance on top of that. I only trust breakouts out of 52-week highs right now. Okay, on the breakout. I don't trust retracements right now. Retracements have been whipsawed so nasty over the last 2 months. It's hard to trust retracements. But breaking of support, that sucker has been very consistent. Support is the most important concept in the market today. Look and just look at the S&P 500, guys. Look at the S&P 500. Once it broke 2,600, which was at 2625 to 2600, where'd it go? It hit smack dab right into that the lows of February.
Yeah.
And where did it hit? At literally on the number yesterday, the support of February. If that level is broken, I don't think it takes a genius to say that's a shorting opportunity.
Well, and think about the logic here, Matt. And I want you to clarify something of what I think you mean here. And I agree with you. You don't trust breakouts of resistance on stocks. But if you had a breakout of resistance in a Forex pair that you're bullish on,
it's stocks.
It's that stocks have been in a bear trend, and now we have a bear movement in the market.
Let's just throw out some random stocks here. I don't care what it is.
Okay. Caterpillar. Let's go. Let's move on to some best stocks.
Because the halftime segment of the halftime report is brought to you by Propel. This shit is actually delicious. If you haven't drank Propel water, it is actually delicious. I'm drinking a delicious kiwi strawberry. So pull up Pepsi.
I'd actually meant to ask you before we started what our sponsor was.
What was the fake sponsor of the halftime report today?
Propel.
Okay, not our Trading Justice podcast, but Propel.
You always make me have to put a disclaimer in these videos.
I like it.
Excuse me.
So Caterpillar here. A breakout of 130 right here is tradable. Okay. But look at 135. Look at 140. Look at the 200-day moving average. Those to me, it's just, I don't trust that. I've seen too many situations where potential reversals have broken out and came right back down.
Okay.
Right. We've seen that a lot. So on something like Caterpillar, I don't know what I would have to do to actually trust a breakout here, because look, it broke out and got just whipsawed right back down. On that breakout right here, that was a legit breakout. The next day, you're like, oh yeah, that's great. Wow. And only if you were a day trader or a very aggressive swing trader were you adjusting stop losses, and the very next day you gave back all your profit.
Hey, Matt, can you let me, I want to illustrate, because I think this is a really critical point. Let me share my screen real quick.
Yeah.
Just looking at Cat real quick, then I'll throw it back. So when things are breaking out to all-time highs, and let's look back in 2017. So what Matt is talking about is during nice trending markets, you have resistance levels form, like we saw in the first quarter of 2017. And so, this is weekly candlesticks. And so when those levels break, there's nothing containing it anymore. There's no moving averages or prior levels of resistance. And so what happens is that you can have these really nice, easily trading situations where you can almost like set and forget trades. And as Caterpillar just climbs up week after week after week, I mean, just look at the smoothness of Caterpillar on these short-term weekly moving averages.
Mm-hmm.
These markets, which guess what? They'll happen again. You're going to have multi-month stretches. There's no resistance levels. So when you have short-term support, resistance form, which will happen, and you break out of those, it's just continuing a nice little trend. What happens during messy charts is that you'll have situations form, but even if Caterpillar breaks out of one level, there's something else it has to fight through from a technical standpoint, whether a weekly moving average, whether another resistance level, whether a previous swing high. It seems like there's always something standing in its way so it can rally. It can have a nice week, a 2-week, a 3-week rally, but then that momentum can easily stop with that next resistance level. And it's just really, really hard to do multi-week trades to the bullish side in these market conditions with these type of stocks.
I agree 100%. This is a great illustration here, Mark, because what happens in that capacity is it's not just the technical condition, it's the behaviorals of the market at that point as well, because we're all trained to do certain things and then we stop doing them when things get a little bit more crazy. And the one thing that really stood out to me as Mark was discussing this, though, was not just the technicals. It really reminded me of the overall market condition we're faced with. And I've said this before and I'll say it again. There are market conditions that it's so easy to make money in those conditions, right? You look at the market in 2017, we never retraced. It was 20% up. You look at the market in 2013, you look at the market in 2011 through 2015 outside of the summer months. Those were very easy bullish trading environments.
And I would like tie it into a thing. Did you need to know what was happening with Caterpillar to trade chart in 2017? Did you need to be a master analyst of its fundamentals No, trade the trend. It was easy.
Yeah.
Guess what? Caterpillar will trend again.
Okay. So can we all agree, don't blow your account in a ridiculous, uncertain environment when there's going to be easier trading days ahead of us?
Yes.
That's just what I've been saying for 2 months now, is be very, very cautious in these environments. Okay, be paranoid to a certain extent in these environments. Wait for the better setups and trade what the market gives you. And if the market right now is giving us the breaking of support, well, by God, let's trade the breaking of support and let's be a little cautious on breakouts right now.
I mean, one of the things that we all make mistakes of from time to time, and it's really easy. As traders, we always feel like we should be doing something. If you just sat back and said, all right, what's my goal for a year? What is really what I'm trying to achieve with my portfolio this year? You don't have to trade every day to be a successful trader at the end of the calendar year.
Nope.
There are going to be time periods. I mean, we've seen it this year. You had a really easy January. You had a really easy, after you got done with that volatility in February, March, and April, and it started breaking out where stocks started.
Look at that trend. Look at this trend development.
Really easy 3-4 month stretch.
Yeah.
Really easy.
Okay, so here's that volatility of the January, February kind of look at it start to slow down here towards the end of April, right? Look at the market start to get a little bit normal. Look at the high base right there. And then once you start breaking out, then you just establish this nice little consistent trend. And if people remember in the scouting reports, those bullish retracements on the scouting reports from June through really kind of September were killers. I mean, absolutely killers. They were just great. Now we're looking at an environment that is completely different. And what my eyes tell me is this market wants to rally back into 2,600, and then we'll reassess at that point. But I'm going to tell you right now, the best trade here is the breaking of support.
2,600 was the key level for me, Matt and Mark, real quick. But is it 2,620 or 2,600? And even a rally into 2,700 would still be a bear retracement.
I'm going to tell you, it's a bear retracement anywhere from 2,600 to 2,650.
Yeah.
You unfortunately, if you're a bull and listen, because whenever you have a market sell off like this, the counter trend trader, all right, this is eventually going to end. I mean, I see any huge major catalyst that is going to send this down another 20%. That's just my opinion. I might be wrong. I'll definitely, the chart, if it breaks that support level, I'll definitely be on the bearish side still. But like, it takes a while, like you saw, like Matt pointed out on the chart earlier this year. It takes a while for all of these resistance moving averages and all of these
to shake out.
It does, and that just takes some time.
Yeah, it's got to shake out.
I'll make an argument for you, Mark, and I'll make it simple. You don't need a reason. Obviously, you guys have been saying it all day. And if we do break down, we're obviously going to be staying bearish with a bearish posture. Silver didn't need a catalyst to go to $50 an ounce back in 2010 when it did. Crude oil didn't need a catalyst to go to 150. Sometimes institutional.
Silver had a catalyst. Zero interest rates, pumping in bailouts,
but it was institutional black pools that drove that price. And we do know that Wall Street drives 90% of price based on algorithms. And if we're in a downtrend, they're going to keep running it lower as long as they can make money lower, right?
Well, Matt, okay. Understanding what Tim just said there is really important to understand how markets work these days. If you're a new trader out there, Tim said something to the effect of, I wish you could do it in your Alex Jones voice. Say,
do it.
I want you in Alex Jones voice to say 90% of price behavior is determined by algorithms.
All right, investors out there, halftime crew, I got to tell you something. 90% of the volume in the market is run by dark pools. Google is the enemy. I'm coming from the bunker right now.
I love it.
So good. Get that conspiracy tinfoil hat on right now. That is too good.
We have we are entering from a technical analysis standpoint. This is as a goal. We're entering a beautiful. There is no reason everyone can't make a boatload. And if I was just talking with you and me individually, I'd be like, there's a shitload of money to be made, is what I'd say. But I want to say boatload instead. Money to be made.
We appreciate that, Mark.
If you understand that price is determined by algorithms, 90% of price behavior is determined by computerized algorithms. You can lament that. You can say, well, that's not the way it should be. It doesn't matter. It's the way it is. You think computers are going to become any less influential over the next decade?
No, more.
Recognize these patterns. Recognize that when the computer bearish algorithms take over, that it takes a while to break out. It doesn't matter what happens on the Fed today from a short-term standpoint. Eventually, it's going to hit resistance levels and push down.
Can I say something very quickly to anybody who may be an Alex Jones fan that watches us? You don't need to put the conspiracy hat on this one. Robots don't control the universe. Most of those algorithms, those high frequency trading systems, are market makers that are literally in and out of a transaction in a fraction of a second.
Yeah, they're not trying to drive the market down. They're trying to make money. And so there's no conspiracy to send the market up or down. They simply see signals and they jump on them. And then when bearish, it's like, there wasn't any conspiracy during June and July and August to send the market higher.
I love that, though. I love that. Every time markets go down, the algorithms are responsible. But every time the markets go up, it's just good old-fashioned people.
Those algorithms were sending it up.
I know.
They pull back to buy points, they buy, and it keeps going higher and higher and higher. When it's just, what are the signals? The computers are passionless.
Yeah.
Buy or sell based on the signals.
And with that said, if this support level, and I'm going to drop down into a 50-minute chart, if 2530 is broken, I can promise you the algorithms will sell underneath that.
Yeah.
They will hammer it and push it down.
That's why breakdowns are legit right now. It's the best pattern out there right now.
Yeah. If you're joining us right now, Halftime Crew, we're having a lot of fun. Coach Matt, Coach Mark, myself, Tim, and producer Cody here for Fed Day. We got a full slate of everybody here kind of breaking things down. A lot of good analysis so far. We got a lot of charts I want to go through here, boys. So let's start moving a little bit through them. S&P breaking down, Matt. Go to the Dow real quick if you would. And obviously,
actually look at charts and you don't just sit around. I just like sitting around BSing.
We do all kinds of stuff. We do that too. Yeah. We do. We've tried to get some formatting here, and I think we're doing a great job on the Halftime Crew. If you guys like us out there, let Mark know that we don't just sit around and BS all day. We do actually get down to business at some point. Give us a like and share as well.
Well,
Matt,
unfortunately, our format for Wednesdays is a guest day, and we typically ask the guests what their thoughts are, and Mark's well
Yeah,
fulfilled.
no, yes, he is.
Cody,
Oh,
the second you come in, it's just
Cody, go on mute before Mark loses it.
I'll let Mark.
I beat Cody. Tackle Trading has a fantasy football league, and there are 4 individuals.
I'm going to mute you. I'm going to mute you.
I beat Cody.
Okay, I'm going to end that so we can get back to looking at the market. Mark beat Cody in our fantasy football league at Tackle Trading because Cody started a player in the playoffs that technically was not playing in the game. So Mark has ammunition over Cody for a year.
For a long time, more than a year, by the way. I know.
The rest of his life.
It's true. Down the S&P are almost
will be Cody.
Say lobby. We talked about those gainers, Matt. Dow, DuPont, IBM, Microsoft, Visa are up. Johnson & Johnson down again. Obviously, that news is sticking. Even on a day where the market is up, it is just ugly.
Mm-hmm.
Mark, you hear the news on Friday, I'm sure, right? They have, yeah. And when you see a big news-driven breakdown, does it change the way you think about the chart?
I usually, what I teach and how what I do is because I believe in technical analysis. I believe computers have I believed in technical analysis 10 years ago. I am a deep, true believer. It is all I use to make my decisions. Now, the enemy of technical analysis is volatility. So I usually like to take a few days off after a huge news event to let the volatility shake out so clearer signals can develop. Because that was like, oh, that's a nice break of short-term support on crude oil.
Oh, yeah, 50 was legit.
That's a nice break. Once again, a nice break. What happens? Break support. Computers drive it down that day.
Yep.
Continue the downtrend. But yeah, so with Johnson & Johnson, I like to wait a few days just to let volatility shake out. So when a signal's generated, I know it has a higher chance of sticking.
Mm-hmm. Mm-hmm.
But yeah, don't put what did they say was in baby powder?
Asbestos. Don't get Cody started.
Don't get Cody started.
Like, that's not good.
No, crude oil's down here as well, Matt. We'll get to crude here just 1 second. Bring me back to the NASDAQ if you would. One of my favorite companies on the Dow is down as well. Intel, we can talk about it with tech here in a minute as well. The NASDAQ has some formation of slowing momentum, by the way. You believe in technical analysis, Mark. When the pivots aren't quite as ugly as we saw in the Dow and the S&P, maybe that's telling us something. If the market does rally off the Fed, it very well could be in tech and in risk on assets. I'm looking at Microsoft, Google, all up a couple percent, Amazon up 1%, but there's a lot of ugly charts across the NASDAQ. There's no doubt about it. Is there anything here that is different in a chart perspective? And Matt, start with you, than you see in the other two indexes?
No.
Yeah,
it's holding support right now at 6,400. Bounced off support at 6,400. I'll tell you right now, if the market rallies, I'm going to miss the rally outside of day trading because I'm not buying anything longer than an hour.
So I will miss the rally 100%.
I'll miss the rally.
If this is the giant rally that sends it back up, I'll miss it for a couple weeks. That's for sure.
Yeah, I'll miss the rally if this is the bottom of the market, Tim. I'll miss the rally. But you know what? I'm okay with that because if that does, we'll start establishing a new trend the same way we did through April through September of this year. And we'll have great swing trading opportunities. But I've seen too much evidence where every one of these rallies have been led into downward movements in price.
Mm-hmm.
And you don't have to catch the bottom to make money in the market. I mean,
it's ridiculous.
I don't think you do.
It's ridiculous.
Like, you don't have to catch the bottom to make money in the market.
No.
No,
that's a foolish mentality that, hey, listen, let's buy the low, sell the high. No, you wait for the better setup, and the better setup is right now is the breaking of support. And if this market does turn bullish, and again, I will miss that rally, but if this market does turn bullish, you know what? That's going to give us wonderful trading environment for the next year.
I mean, Matt, what do you think, like just looking at the chart, is the higher probability that it breaks that support or that it sets a new swing high?
Down.
Yeah, I mean, so if you miss it, you miss it.
lower.
Here's a problem. Let's say it rallies today, rallies tomorrow, gets everybody hopeful, but then it comes smack dab into 6,800 or 6,900 with a downward moving trend line. You still have a downward moving trend line on resistance, so you hit that trend line and then it snaps right back down into support. So, I'm a bear. I'm going to short it as it breaks support.
I mean, plus, let's say that like the market rallies off the Fed. Is that the only negative storyline hanging over the market?
Heavens no. Trade wars galore.
Bulls
Brexit.
win this one. I mean, what else do you have?
If the Bulls are going to hang their hat on a win of not getting a 0.25% basis point hike in the interest rate that is already still underneath neutral, that is still accommodating, and that's what they want to hang their hat on, and they think that's going to stop a global marketplace that is slowing down, revenue projections that is slowing down, a very uncertain trade war between China and the U.S. where they have a date of March 1st to get a deal done, and the UK has a date of March 30th to get a deal done, and a European debt crisis that is still just weighing its ugly head. Call it.
You forgot about divided government that would slow infrastructure spending and could potentially slow down any stimulus is coming out.
A government shutdown is a big deal, by the way, boys.
I forgot a government shutdown.
We haven't talked about this much, but you look at the history, and you guys remember 2010, 11, and was it 12? There were 2 government shutdowns, and I remember August, might have been 10 or 11, can't remember the year now. Somebody's going to have to go back and look at it. We dropped 10% in like 4 days, on the market. So you shut down the government, that could have an impact on stocks.
To be fair, the Dems shut down the government earlier this year, and it lasted for 2 hours.
I get that, but we do remember times where that did have volatility. One stock holding the NASDAQ back here today, guys, we got to talk about it, is Facebook. Facebook's down nearly about 4% here. It might even be selling more into this weakness, down 5.5%, Matt. The DC Attorney General sued them over their Cambridge Analytica scandal. Good. They're clearly not going to get out of the woods of this breach and all of that kind of stuff.
I don't have to know the news. It's what Matt has talked about and mentioned several times in this. A stock rallies. A stock has a few good things. With 1 million resistance levels pressing down on it during the rally. So any pause, anything, just slaps it down. I mean, I don't know what that blue line is. A 50-day. So it came up, so it rallies, and then it comes up against the 50-day, and then stops almost on the penny.
That's the thing.
There's just so many things pressing down.
Well, and the thing in this environment, guys, when you see these rallies, all it takes is one negative news event for it to get just right back down. And that's why I'm not going to trust any rallies. Not until I see a trend.
Yeah, I agree with that. A couple stocks that are also on the upside here today. Take-Two Interactive, TTWO, Matt. Those gaming stocks have been so bearish. So a rally here off of a little bit of a double bottom, but that's just a low base pattern. Interesting market. There's no doubt about it. But a lot of these charts just don't show a lot of upside movement or clear path to it.
Well, and Tim, really quickly on Take-Two, we talked about this yesterday in the difference between reversal patterns and continuation patterns. This is a bearish descending triangle formation. And so you got your head and shoulders formation up here coming down. And look at this. You have support level that's getting held, but you have decreasing resistance levels in this short term. That's a bearish symmetrical triangle right there. So the projection, if you're trading Take-Two or a company like this, and you're looking at that double bottom at 100, and you're like, hey, listen, it's a significant whole number at 100. I'm going to buy it off 100, and then it's like, okay, wait for this to rally back into resistance, and then the ultimate trade here, and patience is a virtue in trading. We've said that before, but the trade here is not the breakout of the trend line. That's not the trade. It's not the trade. Okay, once it breaks out this trend line, let's buy it right there, and it might go up into 110, 112. No, that's not the trade. The trade is to be patient and wait for a close underneath $100. That's the trade.
Yeah, I agree, 100%. These gaming stocks have been bearish, obviously up today, but still got all those bearish signals that it could be playing into.
EA wants to be so stubborn.
Oh,
Take another one. But again, that's a shortable opportunity underneath that low base.
Mm-hmm.
So, just be patient. Wait for the market to give you the right signal, then pounce on the signal.
Another company that had quite a bit of news here recently is Tesla. Not just Tesla, but Elon Musk and his boring company as well. Doesn't necessarily affect the fundamentals of this, but it affects the fanboys. Yeah.
The fake company, boring.com.
Well, you know what's interesting? He started that whole idea with a tweet that was just a throwaway. Half of Elon Musk's idea might just be when he's stoned and he's just saying stuff out of his head. But he's like, traffic is driving me nuts. I'm going to build a tunnel boring machine and just start digging. He thought that was a joke, 2016. They now actually are doing some of this, Matt. Yeah. It's interesting, obviously, very, very cool. If they can, help alleviate some of that SoCal traffic, you've had to deal with that in the past. That would be kind of fascinating to me. Have you seen Elon Musk flamethrower, by the way?
Yes, I've seen all of this, Tim, and I'm completely out on
You're not a fanboy? You're not a fanboy? All right, Tesla. What is the chart? Mark, you're a technical analysis believer. You don't care about who the company is or whether Elon Musk is the CEO or the PE ratio is in the negative. What does the chart tell you on Tesla?
Tesla has been defined over the last year by broad support and resistance levels. You had support levels hold in the fall. You've had resistance levels hold recently. I mean, it's been a very, very volatile stock between those levels. Support and resistance has been the key to trading Tesla in 2018.
Well, that's even what Jake Pelly, we had on the halftime report a couple months ago. He was talking about it. I just wait for the support and resistance on the long term, and then make plays off that. I mean, those have been significant, Matt. We were looking for a breakdown below 250 when the automakers were weak. Tesla did not want to do that, rallied all the way up into resistance. Now we're seeing it fade off of the highs here.
It's the one trade I wish we could have had this year more than anything else was a close under 250 on Tesla. I was ready to pounce on that sucker. I was very upset with Elon, and I wanted to short it. And so I was a little emotional about it, but that to me was probably one of the better triggers that never transpired in 2018.
Yeah, it just never really happened. But now rallied back up into resistance, showing some weakness here off of the tops here. Another stock that's in the news here this week, Matt, is Netflix, and actually having a pretty good day as it's trying to develop a little bit of a reversal pattern. Netflix is a good example where I like the company. I've been concerned. I've been bearish on Netflix actually with the pivots. Like I had a pivot a few weeks ago that was tradable and, that was a good trade actually. Bear rally, pivot, trigger, confirmation. You have momentum change here. It's subtle, it doesn't determine or confirm that the trend has changed. It's the same problem we see in the broad market. Any rally does have more problems in front of it, more resistance. You have that wedge developing. Netflix actually had over 100 Emmy nominations or something like that. They're putting in some pretty positive news last couple of days with all the money they're pumping into new content. What do you see in the chart, Matt?
Bearish symmetrical triangle, probability is 50-50 on either side of a break. You got to wait and see it.
Yeah, I agree with that. Kind of moved into a neutral condition for me on a wait and see. And that's where the whole market's been with this Fed. We're rallying into it. We sold on Monday and Tuesday, a little bit of a pop up here heading into it. We're 35 minutes away from the Fed meeting. By the way, on Fed testimony days, when they release the statement, you'll get initial reaction. But it is the one condition, Matt, one of the major red, economic reports where the actually equity options and futures market are all open at the same time with the Forex market as well. Not all economic reports are. In fact, much of the data comes out pre-market for that reason. They want to avoid having the stock market open a couple hours of trading after. So there's all kinds of things that can happen between now and the end of the day.
I will tell you, Tim, I will be trading the Fed today. Mm-hmm. I will most likely be trading the secondary response to the Fed, not the initial response. Remember, for the day traders out there with the Fed, this is unlike an unemployment report. This is unlike a pure economic event where we have an analyst expectation and then we see the number coming into the market and then we see the movements based on the actual number versus what the expected number was. The Fed is not just the actual interest rate announcement. In fact, the interest rate announcement on this one is secondary. Whether they raise or they don't raise is not the most important thing. It's the most important thing is what they have projection for 2019, what they say in their statement, and then in the Q&A function that Jerome Powell will have after the actual announcement, which I believe is 30 minutes after the announcement. And the market will move based on that. So when I talk about the secondary move, I'm more talking about not the actual number, but the secondary move in the market that is based on what happens as the entire financial world, reads the policy statement, gets the analysis of the policy statement, sees the news headlines coming out on the policy statement, and then everybody's going to be watching Jerome Powell's Q&A.
Yeah, I agree with that. You brought up a chart of the dollar, Matt. I'm looking at the currency markets as well. Dollar's down 0.45%. Does this change that ascending triangle? I mean, you see those lines you drew.
If the Fed's projection comes out and they say we're not raising interest rates and we're going to lower our projections for 2019, the dollar should sell on that.
Quick rapid fire.
Hold on. One thing. This is one thing that drives me crazy, and then Mark, you finish here, is the fact that all these people on Twitter and these news outlets and is saying, hey, listen, don't raise because it might hurt the stock market. Well, if you don't raise, it hurts the dollar, it hurts savings, it hurts this. So there's an economic impact in some capacity, and the stock market is not the end all be all of economics.
The chart on the dollar is fascinating. All right. So let's say we get positive bullish sentiment coming out short term from the Fed announcement today. Well, you got resistance level, resistance level, resistance level. If that is negative for the dollar, if the Fed gives strong indication that it's not looking to raise rates in 2019, the dollar could get whacked here.
Could get smacked.
Because it could break through, because the dollar has been trading for several weeks now in a high, a rough high basing situation. You could have a situation where there's a lot of room to the downside on the dollar. If it breaks those short-term support levels, those short-term moving averages.
Keep an eye on 96.40 here on the downside.
So there's a lot of other storylines with the overall stock market, the equity market. With the dollar, there could be some excellent bearish opportunities.
Yeah.
And some short-term trend reversals.
Yeah, and again, we don't know. We have 30 minutes until we start to know exactly what's going to be transpiring here. So we're all kind of speculating on Fed Day, which is normal on Fed Day. But you got to prepare for how you're going to attack the market after that. And for me, as a currency day trader and swing trader, I'm looking at my two levels, and I got a level that I'm tracking at the low of today. That's number one. The second level would be 96.40. The third level on the downside would be 96. By the way, the break of 96 would be a trend reversal.
What's funny is that in our speculation over the last hour, and even before that, so for the last couple hours, we keep speculating that the Fed is going to capitulate to Trump. Even though we haven't said that amongst the three of us, that's what we've been speculating, that it's almost like we expected. If the Fed does not capitulate, let's say the Fed says, no, we're raising interest rates today, and screw y'all, we're going to raise them twice in 2019, according to our projections.
If they indicate 2 to 3 rate hikes in 2019, followed by an interest rate hike right now, market sells. And sells.
Market sells, dollar rallies. So we've been hypothetically speculating if what might happen if the Fed does nothing or basically capitulates to the political pressures. If they don't, then that market could break that long-term support from 2018.
And I'll tell you, even if you don't trade currency, watch the dollar's behavior today, because the dollar will be the indicator of what the market thinks the Fed is really going to do.
And watch what the dollar does over the next 3-4 days.
Yeah.
If the market holds support levels, that's not good for the equity storyline.
And I want to respond to Dustin. Dustin said, I'd be surprised if the Fed follows Trump. I would be too, Dustin, up until the last 2 weeks of Fed speeches that have been, we're close to neutral, we're close to neutral, we're close to neutral, and the market has still been selling in that environment. What the Fed was trying to do with those speeches, and I know the Fed very well, what the Fed was trying to do in those speeches, guys, is they were trying to give the market some stability, and the market did not take the stability. So it was kind of like a warning shot, Dustin. And now for me, it's going to be interesting to see if the Fed does capitulate, because they were trying to smooth out the volatility in the market over the course of the last 2 weeks, and they did not accomplish that. So is the gangster Jay Powell going to continue to be that? I don't know.
I mean, there's been speculation, and it's been said for months, there's no Powell put. There's no Powell put. Yeah. Is that true? We'll have a little indication if there actually is a Powell put.
Yeah, I don't know. But that here's the thing. A lot will be clarified today. okay, based on what we all of us have been trying to interpret from these Fed speeches, the Fed minutes, the beige book, all of this stuff. We've been trying to interpret what the Fed is going to be doing. We're going to know exactly what their short-term plan is later on today. It's going to be absolutely fascinating. But regardless of what the Fed does today, does not change the overall economic tune around the globe that we are seeing company after company get concerned about slowing growth and slowing growth in sales. Corporate sales are down. Housing sales, we saw a little mixed bag there. The only type of sales that we've seen is consumer sales, which has still been very, very good. But outside of that, the projections in 2019 are a reduction in revenue. And so economically, I don't believe the Fed changes that long term. We have to see those things play out in the first quarter of 2019, specifically regarding the European debt crisis, specifically regarding Brexit, and specifically regarding the trade war between China and the U.S. Those are the primary catalysts that could create black swan events or could create an environment where the market does start getting bullish. So I don't think we're going to see anything to the bullish side that changes long term today. Now, could I be wrong? Yes, but I just think there's so much over economically that from a geopolitical risk perspective that there's nothing going to be changing that today.
I agree. But what is interesting is all the volatility, and there are many markets moving. Obviously, here, usually gold is a safe haven, Matt. We haven't looked at the commodities yet. We're going to run through these real quick. Gold pressing the 200
gold
MA
is a safe haven. What are we doing? Gold is a safe haven. Period. End of sentence.
Well, Wall Street wouldn't end of sentence that. Some people would debate with you. I do agree with that.
Debate all day long. That's fine. Yeah. They said the same thing about Bitcoin. How'd that work out?
Bitcoin up today, 7%.
Okay. Let's all go buy Bitcoin.
At the 200 MA, it's not an entry point necessarily. And
a break above 1260 is a new entry point.
I agree with that, but not in front of the Fed here. I think you would wait for clearance here.
There's a reason there's a reason gold went up, came back down. I mean, everybody's waiting on the Fed at this point.
Yeah. Crude oil also back up off the lows here. That break below 50 had a $4.50 move.
Before we talk oil, very quickly, if the Fed goes dovish today, if they lessen their stance, and the dollar does sell, keep an eye on gold.
I think gold could take off. Yeah, it's one of the things I'm focused on very closely. There's no doubt.
No, I mean, if you want to look like at unmuddled waters and want to make some trades off a Fed announcement today, equities is tough because you have so many things. Gold, dollar, like being able to go to markets where the technical signals and the storylines, if you use sentiment, it's a lot clearer. I mean, gold has a really nice technical setup for a bullish move.
I would rather buy gold above 1260 than buy the S&P above 2600.
Yes, that's gospel right now. Yeah. That's gospel.
Got to look at oil and nat gas. You can look at either one order or the other here, Matt. Natural gas down again. Oil back up a little bit here, but this was one of the best technical setups in the market when it broke below 50. We talked about it on the commodity report. We talk about it every day in the halftime report. The primary trend was down. It compressed and then broke down and sold. A rally here, same thing with the market. It would just be setting up into a bear retracement on any rally here. Here's one, guys.
Hit his first target that we talked about, Tim, at 46 to 47. If it breaks 46, the next target's not till 42. So,
all right.
You got room down.
Here's an argument I'll make to both of you, because both of you are saying, well, what about the fundamentals long term? Oil at $30 a barrel means job layoffs and economic problems in many places in this world, including the United States. Could a bear market in oil drag the overall economy lower?
Of course. We saw that in 2014 that led into the stagnation of 2015, Tim. You saw 250 to 300,000 jobs lost in Colorado, the Dakotas, Oklahoma, and Texas. So absolutely, but it doesn't take oil going down to 30 to do that. It takes oil going down to 42 to do that.
Yeah, I've heard this number, and I don't know the accuracy of it, but anything below 50 is pretty hard to build profit with some of these oil companies.
One of those numbers that has been thrown around for years and years and years in the marketplace, and it's just became part of the gospel out there, whether companies are, and by the way, companies are profitable depending on a variety of different economic conditions, not just the valuation of oil. That's number one. But number two, it depends on the company. It depends on the country of origin where oil is being produced. The 50 number has just become this number in the energy market that we have been utilizing for the last few years. Yep. Whether it's anywhere between 40 and 50, that's where I kind of lean.
I heard the Saudis can make money at $20 a barrel, so I don't know if that's true either.
That's not true. That's not true. We saw what happened with Saudi Arabia in 2014, 2015, when they went into debt over $100 billion because oil went to 27. So we heard that for years, that Saudi could be profitable at oil at 20 to 25, and yet they had to go into debt and they had to cut pensions in Saudi Arabia, which is one of the richest countries because of oil. So these numbers get thrown out. I'm going to go back to what Mark said originally, and it was genius. It doesn't matter the economic condition. It doesn't matter the reason we give something. What matters is oil broke $50 and everybody starts shorting it under $50.
Mm-hmm. Mm-hmm. Yeah. Natural gas, give me a quick one here, Matt. Untradeable recently, obviously down again here today. Big rally, big sell, big rally, big sell. Untradeable. Just untradeable until we stabilize.
We will state when it is tradable. I promise you that, because I swear to heaven you'll have me start. Basically, I know what will happen. I'll start doing cover calls on natural gas, and I'll start loving it. I'll start talking about it, and it's just I should get paid by natural gas.
Mark, you did a great job on the option report this past weekend, by the way. Yeah, really, really liked it. One stock that I think is setting up a very interesting pattern technically on this intraday is JP Morgan, Matt. It was on the option report for a breakdown below 100. It did break down below 100. Now we have rallied back to 99.67. I got a question, and I don't want to go, on a 15-minute rant about this, but I do need to, Matt, for you to clarify this for our students out there. I had a student email me and say, hey, I think I need to put my stop higher than the stop on the report. And I was telling him, well, we don't recommend stops on the report.
Hold on.
That's the first stop zone. Okay. And you have to understand how that information is being done.
When the stop loss says stop loss at 101, it's 101 or above.
Yep.
Okay, because what we do in the stop loss is we put the first stop loss, which is a very aggressive stop loss, and it's a stop loss that I very rarely change. But it's not my job to tell a trader where to put a stop loss, because there's all these different systems and rules and whatnot. So my stop loss rule is what it is. But when we use the stop loss in the scouting report, that is an aggressive stop loss. You have the objective a situation where you can put it above that level. You as a trader have to make that decision. Okay. Mm-hmm. Those entries and targets and stops, those are projections based on technical analysis. So
let me talk about JP Morgan.
Yeah.
Let me pull up my chart.
Let me just finish my thought. So your stop loss, that is an aggressive stop loss. If you want to put a more conservative stop loss, you should do that. You should go through, you should prep the trade how you're comfortable with the trade. I'll tell you, I'm usually a little I'm always more conservative with my stop loss than what we put in the report, because that's who I am as a trader. I'm willing to take on a little bit more risk. But the first stop loss placement is always the first technical stop loss that makes sense from a technical trader's perspective.
Correct. Mark, give Mark the screen for just a minute.
Finish up, and I'll use mine as the last thought, just to talk.
Here's our last thought. A couple of things. Number one is we have just released a system on tackle trading called System Development 101. And I'm very excited about it for our students, Matt, for our community. If you are a tackle trading member, go check it out. That'd be the one thing I'd say. And then, Mark, why don't you take the last, analysis?
Like, there's not one successful and only way to trade. So let's say you have a trigger, a break of support. And let's say it's at that $100 level, which totally logical, nice setup, short-term support, breaks that and breaks the $100, that magical psychological level. So you get a signal to get into a short-term trade. So a break of 100, we're in. How we manage that has a lot to do with your own personality. For example, I use short-term moving averages a lot. Now, if I want to be really conservative and when I get a bearish signal, I will use like weekly moving averages to have my guide. And so that's when I want to be into a trade. And I'm like, I really like this signal. Forget short-term volatility. I'm going to be in this trade for weeks and weeks, maybe even months, and play that breakdown. Stocks like AAG, where you have those big breakdowns where that would have occurred. Great way to play that. Would have been a very profitable way to play that. Being like, all right, I like this support level. It breaks. I get my signal. I'm going to use weekly moving averages. Guess what? You'd still be in that trade. You still would have made a ton of money, still be in that trade because I used a longer signal. But let's say you want to use a shorter signal. Well, a shorter signal on a break could be a daily moving average that is coming up and hitting. Let's say I want to be a quasi really short-term signal or a short-term day trader. Well, I could go down to hourly signals or 15-minute signals. There's a lot of ways once a signal is generated. You break support, AIG, GE, JP Morgan a couple days ago. So we all have a signal on how we get in. I'm like, that's a beautiful signal. Mm-hmm. Now, how we manage that trade, a lot of it is the type of trader you are. Sure. A short-term trader, a day trader or a really, really short-term swing trader would have already been in and out of JP Morgan, made some money. A longer-term positional trader, well, that was the start of the party. So who are you as a trader? Who do you want to be? What signals are you going to use?
Young Cody told me the other day that you taught him to use the 13-minute chart. He put this on you. Is that right?
That I did.
Where'd the 13-minute chart come from?
Who made that one
up? Cody says Mark did.
I got that one from Mark, yeah.
Yeah, you guys can trade a 13-minute chart all you want.
Well, let's walk through JP Morgan on the 13-minute chart.
Anybody can make a trade off any time frame that they want to choose, but you got to do time frames that people follow.
Well, also, Coach Keith uses a 3-minute chart, which I find interesting as well. I mean, listen, whatever works if you have a system. I think the thought there, Matt, is like designed and developed.
I'm going to be very specific on this.
Okay.
Any tackle coach that comes to me and says, hey, listen, let's use a 14 EMA crossing over a 22 SMA followed by a 64 time frame EMA, I'm firing them on the spot.
What if it's got back-tested data back to 1985?
How about we not try to get too cute and too creative and just trade things that work?
Well, maybe the 13-minute works.
Did you know that the stock market day is broke down into 13-minute increments?
Hey, Matt, what if they use the System Development 101 to figure out what this indicator?
Then good on you.
How many hours is the market open? 6.5 hours. You divide that by 13, you have an equal number.
Can I get a tinfoil hat with some Illuminati?
Hey, give me an Alex. Let's finish it. Give me an Alex Jones 13-minute rant.
Here's what you got to understand, guys. The 13-minute chart is what they use in the dark pools in New Jersey. Now, they do not use that on Wall Street. They use it in New Jersey.
It only would have been better if it was Long Island.
Oh, c'est la vie. All right, guys. Who's having more fun than we are at Tackle Trading? We'll be back here tomorrow. The market's going to be moving 15 minutes. Stay in front of your screens. Make sure that you're watching. And really, to me, I don't care what it is you're doing in terms of every little tiny detail. Stay risk averse. What Matt said earlier is important. Don't ever run your account into the ground, into a big drawdown just because you're over leveraged or oversized. Make sure that you're trading like a professional. Okay. We'll see you guys back here tomorrow. System Development 101. Go check it out.